Hey Jim, I'm wondering if you have tips about how to start transitioning from all tax protected accounts to opening a taxable account. I've been maximizing contributions to a 401k, a 457b, HSA, and backdoor Roth for my wife and I since finishing residency, and everything else has gone towards my loans, which I just paid off. Now that extra money is going to a Vanguard money market account towards a down payment on a house. But after we buy the house, I'll start putting those savings into a taxable account. But I'm struggling to figure out the best approach for this. So my 5 aforementioned tax-protected accounts have about $100,000 between them, and each of them has a basic 3-fund portfolio of total stock market index, international stock index, and total bond index, each one at my desired asset allocation. I know, however, that my new taxable account should preferentially contain tax-efficient funds like the total stock market index, and the tax-free accounts should preferentially have tax-inefficient funds like the bonds. Well, anyway, this throws off my system of just having the same asset allocation in all of my accounts. And so I'm envisioning putting all my extra savings into a total stock index fund in the taxable account, and then adjusting my allocations to my other 5 accounts to be more bond-heavy. But how do you do this and maintain your asset allocation across the board? Any tips or resources would be helpful.
So he's basically asking, how do you start a taxable account? Well, unlike a 401k or a Roth IRA, where if you kind of botch it a little bit in your investment selection, there are actually consequences to changing your investments in a taxable account, as we learned on that last call. If you have capital gains, it's going to cost you some money to change investments. And so most people inside a taxable account try to stick with pretty tax-efficient kind of investments. So if you're investing in bonds in your taxable account, you want to be using muni bonds if you're in one of the higher tax brackets. If you're investing in stocks, we're usually looking for something like a total market index fund, the total U.S. market, total international market. Those are kind of the holdings you have there. If you're investing in real estate, rather than put your hard money loans there, your debt kind of investments, you should instead put your equity real estate investments in there, because you can shelter some of that income by depreciation. And some of it, of course, is going to come in the form of capital gains. And so that's better than the ordinary income you'd be getting from most debt deals. And so you want to set it up right the first time if you can. And then, of course, as time goes on, one of your accounts generally gets bigger than the others. Whether it's your taxable account, whether it's your tax-protected account, you will find that you are moving portions of your asset allocation from one account to another. You're essentially buying more of, small value stocks or, total international stocks in one account than you had in the other one. And so in general, what you want to do is avoid realizing capital gains as you do that, and stack them into the taxable account if necessary in order of tax efficiency. You don't want to necessarily take your real estate investment trust and put them into the taxable account first, because that tends to be a very tax inefficient asset class. You generally try to avoid putting TIPS, Treasury Inflation Protected Securities, into a taxable account as well for the phantom tax issue, where basically they're sending you a tax bill for appreciation that you're not actually getting on that investment. And so that's generally held in a tax-protected account as well to avoid that complexity. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.